Good afternoon, this is Sean Golding with Golding & Golding here to discuss some of the more common international tax forms certain U.S. persons may have to file, whether they live in the U.S. or abroad, if they're a U.S. citizen, lawful permanent resident, substantial presence test. So let's jump into it. So first of all, who has to file these darn forms anyway, right? Well, there's three main categories of individuals. We're just dealing with individuals. Entities may have to file it as well. Typically, it's going to be a U.S. citizen, born or naturalized, lawful permanent resident, foreign national who meets the substantial presence test, permanent residents who make a treaty election that are living in a foreign country that's a treaty country to be treated as a non-resident for tax purposes. The IRS takes the position the forms are still required. With the recent ROS Day case, it's a little bit up in the air, but the IRS still takes the position that you should file the forms. Substantial presence test, if you can show you have a closer connection, or if you meet some other exception, then you may be considered a non-resident alien. You may not need to file the forms or some of the forms in certain years. The three most common forms, right? The FBAR, almost everyone probably knows about the FBAR these days or has heard something about it. Foreign bank and financial account reporting. It does not require that you have income generated from these accounts. It does not require that you have to file a tax return. If you're a U.S. person, then you have to file the form if you meet the threshold requirements. FATCA Form 8938 is a relatively newcomer, introduced in 2012 on the 2011 tax return. It's similar to the FBAR, but the FBAR is filed through FinCEN because it's not technically a tax form. Form 8938 is an IRS form, and it's submitted with your tax return. There's different thresholds depending on whether you live in the U.S. or whether you live abroad, and whether you're filing single or married filing separate versus joint. Form 3520 has dual purposes. We'll get into that for a moment, but one of the more common reasons you have to file it is if you receive a gift or inheritance or trust distribution from a foreign person. So the common example, you're living in the U.S., you became a U.S. person, maybe you graduated school, your parents want to help you purchase a home, so they gift you some money. You don't qualify for a mortgage because you don't have credit yet. That gift is reportable even if it's not taxable. Failing to report it can lead to penalties upwards of 25% value of the gift, which is why it's super important to file. The Form 8621 is a PFIC form, Passive Foreign Investment Company. 8621, Passive Foreign Investment Company. There's lots of different types of companies that could qualify, but most of the time the reason why a U.S. person has to file it is because they have a foreign mutual fund or ETF. Technically, they kind of get pulled into the PFIC black hole. 8621 has some legitimate exceptions as to whether you have to still file the form or just part one of the form is up for debate. Most people will still file it anyway. There are certain exceptions for treaty countries, pension trusts type of holdings, but for taxpayers who have to file the 8621, the problem comes in if you have an excess distribution. Excess distributions get taxed very harshly. So if at all possible, it's better to try to avoid having a PFC if you can. 3520A is used for U.S. persons who own foreign trusts. It's a little bit different than the 3520, which we'll jump back into in a moment. It's similar to like a 5471 balance sheet type of setup where you have to report. It's not due in April. It's due in 75 days after. So for most people, it's going to be March 15th. Okay. In order to file an extension, you have to do a 7004. You don't do the 4868. The IRS likes to penalize the form, so it's one of those forms you want to try to file timely, and there's ways to substitute file it if the trustee never files the form. Now, 3520, I had mentioned earlier, is primarily used for U.S. persons who received foreign gifts, foreign trust distributions, or foreign inheritance. But if you're a U.S. owner of a foreign trust, well, you have to file it for that as well, and it's much more complicated to file a 3520 when you own a foreign trust than it is, for example, just to report a gift. When you're reporting a gift or an inheritance, you just report the date, what it was, and a value. If it's ownership of a foreign trust, it's more complicated. The due dates are different for some of these forms. Like, for example, the FBAR is on automatic extension. The 8938 is due when your tax returns due. 3520A is typically due March. So it's important to note the different forms. If you're required to file it when the due dates are, there's typically ways to file extensions for any of them. These forms tend to get penalized a lot. The 8621 is a little different. There's no monetary penalty, but the return remains open, and having to go back and file late 8621s with PFIC excess distributions can get expensive. For taxpayers out of compliance, there's various programs you can use to get into compliance. If you're willful, there's the VDP program. If you're non-willful, there's the streamlined procedures, delinquency procedures, and reasonable cause. We have a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.